In today's video, I'm going to be showing you how I've been looking at the markets for the last 4 years. This concept and understanding transformed my trading results incredibly fast, and I wish I had found this earlier. My name is Lou Burton, co-founder of Not Just a Trade. We day trade Euro USD on the 1 minute chart, and me and Chucks have a combined trading experience of 17 years in the Forex markets. So let's get into today's video. Someone asked me the other day, why do I think people look at the market wrong? And I think people start with structure rather than starting to read the intention. Trying to read the intention first means that you can read the direction of the markets on the higher time frame and the lower time frame, and then correlate the two to build high probability trading ideas, because you'll learn how to read the language of the market. So starting with a range is like the Big Bang Theory. It all starts with a bang and everything is created from that one explosion. The same with a range. That creates intention, it creates direction and gives us something to follow. And much like the Big Bang expanded, the initiation out of the range shows us the expansion in price. So today I'm going to show you how we read the market in NJT, and we'll start with ranges. So what is a range? This is where price is contained between a high point and a low point so that the banks can trap volume and use this volume to create large orders into the market, disguising them with smaller orders before they initiate price in their intended direction. This is where the banks start, and it's their moves that we are trading, and it's their intentions that we need to follow. They have the capital to move the market, so if we can read their intentions and their direction, we can get involved alongside them and capitalize on their moves in the market. This is where intention is created minutes, hours, weeks, months, and even years in advance. So we're here on a monthly chart here, and I just want to show you that the intention is created years in advance. So we can see that this is a contained sideways range here. I'll just take off the volume tool so that you can see that price is just contained between this low point here and this high here before price has initiated to the downside. So this range was created in 2017 and it wasn't mitigated until 2021. So that's a 4-year difference between the range being created and the intention following through here to the downside. And it's the same here. We have a sideways range here created in 2015. It wasn't mitigated and the intention continued until 2020. So they were in drawdown for 5 years before their intention played out to the upside and to the downside. Banks can hold their drawdown for years to play out a future intention. And this is how far ahead they are. This is how controlled and manipulated everything is. Most of the time, these major events that you see in the news are priced in ahead of time and orchestrated at the perfect time, right as price gets into a point of mitigation, so then they can use that volume that's going to come into the market to carry on their intention. So this is monthly. Again, the price is fractal. So if you was to go onto the 1 minute chart, we'll be seeing 1 minute intentions following through, and that might take, 15 to 30 minutes for those intentions to follow through. And obviously the higher up the time frame, the longer it's going to take for that intention to follow through. We even have ranges that are up here from 2008. These will be mitigated at some point in the future. We don't know how long that's going to be. That's going to be years from now, of course. This is just to show they can hold volume in the market for years and years and years before they eventually mitigate out of this volume. These are the people that do control absolutely everything. So there's no reason why they can't hold the volume for years and stay in control for a very long time. So now you understand ranges, right? This is where the volume is trapped in the market. This is where they create the intention. This is also where we've created that RAMC price delivery range initiation. When we come back into that range, that's the point of mitigation where they close the sell orders used to buy price here. That's where we see the reaction. This is also an opportunity for them to create new orders here in the market to continue to stack on the volume. And then we get that continuation phase in price where price targets that high, and that completes the sideways range, intention shown, pull back into that range, mitigate out of the orders, and then continue that intention to the upside and target the high that's being created from the intention in the market. So this is how we get a very clear intention and a very clear direction from the market. When we're trading at that point of mitigation, this move to the upside, if this is a daily chart or a monthly chart or a weekly chart, we have very clear direction for a very long time in the market. Now, again, we can use this on the 15-minute chart for those intraday moves as well, with that clear direction in mind. And we can use this as an entry tool on the 1 minute chart to enter those high probability positions in the direction of the higher time frame.
We interrupt this video to show you Not Just a Trade's community winners.
now I'm just going to show you here on the 15-minute chart. We're just intraday. We're day traders, so we focus more on those intraday timeframes. We have a perspective of where price is on the weekly, daily, 12, so on and so on. And we use that for our direction in the market. For example, if we was to go up to the 4-hour chart, we can very clearly see that price is bearish at the moment, which means overall on the lower timeframes on those 15-minute charts and those intraday charts, we want to be looking for those bearish RAMC price deliveries and get involved in those continuations to the downside, because that's what's going to follow through. That's the intention of price at the moment, is to see continuation to the downside in line with the higher time frame. So we'll be looking for selling RAMC opportunities during our sessions. So a question we always get is, how do we identify the ranges on the charts? Now I'm going to show you a quick and easy way to do that today. All you have to do to understand how to find the range, now you understand the logic of why ranges are created, why they're so important, and you can start to read the intention and the direction in the market. Now it's actually about identifying that logic on the charts. So here's the way, right? If you can't understand a sideways range, or you can't find a sideways range, or you can't read it between the candles, look for the initiations in price. This is a very aggressive move in one direction. It normally leaves imbalance in the market, and that's a gap between the candles. And once you can identify the initiations, go back and find the highest point and the lowest point, and that becomes your sideways range. So I'll just show you in a drawing first. So find the initiation in price. That's a very aggressive move in one direction. Go back, find the highest point of the initiation, find the lowest point, and that is now your sideways range, right? This is where price is then contained here before initiating to the downside. And that's where we find our sideways range in the market, followed by that initiation to the downside. So if you're struggling, find the initiation, the aggressive move in one direction, go back, find the highest point, the lowest point, and that is now your sideways range. So when price comes back in here in the future, that's an opportunity to play that range initiation, mitigation, continuation to the downside. So just on the chart now, all I'm doing is highlighting all the initiations that I can see in the market. That's those very aggressive moves in one direction. And then what we'll do after this is we'll go back into this move here and we'll look for the sideways range. We see we got another one here as well. Very aggressive initiation here, another initiation to the downside here and here. And all I'm doing is just picking the most obvious ones that I can see in the market that have created that imbalance, right? And then we can go back and we can find the ranges using that same process that I showed you, right? So this is all the initiations that I can see that come to eye straight away. Of course, there's many more initiations in here as well with just one candle initiations, but I'm just picking out the ones that are most obvious. Now let's go back and find the highest point and the lowest point. So this is the initiation here to the downside. This is the low of the initiation. So we go back, we find the high, we find the low before price broke out to the downside. And that is how you find the sideways range and initiation, which is that first point of price delivery, range and initiation, and that creates intention of lower prices. When price comes back into that sideways range, this is where we go down to the lower time frame and we look to trade that continuation to the downside here as well. So this is how you create narrative in price as well, and this is how you create the narrative of the session or the day, and you can use this on every single time frame. So again, this is the initiation. What do? We go back, we find the highest point, we find the lowest point, and that is now the sideways range. Sideways range, initiation, we pull back into that range, mitigation, and continuation to the downside. Again, same here. We've got an initiation here in price. What do? We go back, we find the highest point here, we find the lowest point, and that now becomes your sideways range here before price initiated to the downside. It's the same again here. We find the initiation, which is that aggressive move to the downside. We go back, we find the highest point, we find the lowest point before price broke out, and that is now your sideways range in the market. We can see that we get this sort of price delivery where price is mitigating and just continuing its bearish order flow in the market. A lot of people might just see this as structure, higher highs and higher lows in the market is also that, but it's the RAMC that's creating that structure. Every single point of mitigation from these lower highs is from a sideways range. So this is how you can use the structure and the range initiation, mitigation, continuation together. And this is how you can find unmitigated ranges as well, right? So we see an initiation here to the downside. We go back, we find the highest point, the lowest point before price initiated to the downside. Now this is left unmitigated for a future intention. So when price comes back up here in the future, we will react out of this place because there's orders still left in the market here that are left unmitigated. And we can see those orders from just using the volume tool. All these bars here show volume in the market. The initiation typically has less volume, and the range is where all the orders are stacked, and this is why we have more volume in these areas. So again, we'll just go back. We find the initiation here, that very aggressive move in one direction. We go back, we find the lowest point here, and then we find the highest point before price broke out to the upside. And this is now a range. Price will react out of this range here in the future, and we can see that price is moving to the downside. So if price gets down to here, we will see a reaction. If that reaction follows through and the intention follows through from this sideways range and initiation to the upside, this high will become the next target. So if price does get down here, we see a momentum shift, we start seeing continuations to the upside, we have a very clear direction now for the next day or two up into this high for continuation. And it's exactly the same if we do this on the other side here. This point of mitigation has come from a sideways range that we see here. Price was contained sideways here before they initiated price to the downside. And we can see that aggressive initiation to the downside coming in. Again, we go back, we find the highest point, the lowest point, and that's our sideways range for the future. So when price gets back into here now, because this range has created this low down here, even though it's, it's very high up and price is initiated and, in that initiation, we've come back and we pulled back, it's created this low down here. So that is the first part of sideways range and initiation. It doesn't matter what it looks like coming down into that low. It's just price creating a low from this sideways range. Now, if we react and follow through, this low is going to be the next target, which then means that if we're trading continuations here to the downside, we have a clear target that price may target this low. And now we can trade those intraday moves down into this low here as well. And that's how you can use the RAMC price delivery to create narratives in the market and see direction in the market. And that's how you can trade alongside that direction on the intraday timeframes. So we'll just go through a couple more now as well. So we can very clearly see here, price initiated to the upside. We see the aggression and speed in the market. We see the imbalance that's created in the market. Again, that shows aggression and speed. Then we go back, we find the lowest point, the highest point before price broke out. And there we have our range initiation, mitigation, continuation to the upside. Now we can very clearly see that price came back here again in the future. Now, when we're thinking about price contained in a sideways range, we're looking for those buy low and sell high locations. So if price has mitigated out here in the past and seen continuation, and we've stayed contained in a sideways range, again, all we're going to do is just look for the sideways ranges that are created at a low price. And price can come back here again in the future, and then we can trade alongside that intention on the lower time frame again in the future. So again, I'll just go for a few more. We look for the initiation, we go back, we find the highest point, we find the lowest point, and that is our sideways range. And then we can see that price comes back here again in the future, and we get that mitigation out. And like I said, when we're contained in a sideways range, we can come back into those points of mitigation at high prices again in the future and play those intentions again to the downside. Again, here we have that initiation in price. We go back, we find the highest point, we find the lowest point before price broke out, and that is then our sideways range. And we can see that price did react out of this during that news event, but that was just a small reaction on a lower time frame. We reacted, mitigated out of those orders, and then we used that volume to continue moving price higher. And this is where you're against the momentum. This is what quite a lot of people get in their trades. They get tapped into a trade, they see a reaction and price continues. All it means is you're on the wrong side of the intention. It's just then about zooming out from the higher time frame and actually reading that intention and learning how to be on the right side of the intention. As we see here again, we've got an initiation here to the upside. We see the aggression and speed. We go back, we find the lowest point here, we find the highest point, and that is now our sideways range. And we can see that that's where price mitigates out from in the future. Now, this is the 15-minute chart, right? This is how we use range initiation, mitigation, continuation to build high probability trading ideas. And we trade that same intention on the 1-minute chart by just zooming into these mitigation points and looking for our continuations to the downside. If we also pair that with the higher time frame perspective and the higher time frame sideways range at initiation, and now we're back into that point of mitigation, now we can use that same price delivery and we can use that same understanding for our direction, but for just a longer period of time down into that low for continuation. This is how we can read the higher time frame direction and trade it intraday on the lower time frame and the 1-minute charts as well. So this is why we always talk about the RIMC concept We put the pieces of the puzzle together to understand this repeatable price delivery. Then through thousands of hours of observation, we've perfected our entries, narrative building from the higher time frame to the lower time frame, and the precision entries to be able to make 10% on a single trade. You've seen me go through how we create the narrative and the understanding and the direction of price. We can also go to the 1 minute chart and use this as our range, initiation, mitigation, continuation, price delivery. And all we're going to do from that point is we find the lowest point of the range, like I said before, we find the highest point of the range, and now this becomes our continuation area, right? When price gets back into this mitigation area, this is where we would put our entries on. We would put our stop above the high here, because price is never going to move higher than the orders created inside this sideways range, because that's where the intention's created. They're never going to move price higher than the high of the intention. So if our stop goes above here, that is a safe stop entry for a continuation. Now, like I said, we've got our narrative from the higher time frame, from the 15-minute chart, from the 1 hour, the daily, the weekly, the monthly, whatever range that we're playing out of or mitigating out from is our intention direction. And this can happen on any time frame. This is why we have so many time frames, because all we're doing is looking for the intention on these time frames, and then we can zoom in and trade those intraday moves in line with that higher time frame direction or that higher time frame range and intention. And when we get down to the 1 minute chart, we look for that same price delivery in the direction of the intention. And this is where we get involved. We put our stop above the high because we know that that's safe. And we always look for 1 to 10 risk to rewards. And the reason we look for those 1 to 10 risk to rewards is because we're playing that higher time frame range, right? If we're getting out of that point of mitigation here and we're playing that as continuation, and then we're using the 15-minute chart to get involved in our intraday moves, that move from the high here of this range or from the mitigation all the way down to the low, this is over 129 pips in the market just for that one move there to the downside. So if we can enter these trades with a 2 to 3 pip stop loss because we're being so precise, getting those 20 to 30 pips out of the market when we're expecting that 129 pip move is a lot easier to do. Our AMC gives us that precision entry and that precision understanding of the direction in the market. We know exactly where to put the stops so that they're in a safe location. And we understand that we're playing the expansion of that big bang in the market. And that's how we're able to use RAMC as the narrative entry to gain precision and 10% gains on a single trade. Of course, we explain all of this that we've just seen today in detail. Every single element of what I've just spoken about is in our course and our videos and all the content that we've created inside the community. And if you want to find out more about how we trade these markets with precision, you can visit our website at notjustatrade.com. You can also find us on Instagram at notjustatrade. Leave us a like and comment if you did enjoy this video, and feel free to share this with other people as well. And we'll catch you guys on the next video.